Hey everybody, Ken Malott here. I want to make a video based on the events of the last few days. Obviously, I'm talking about the failure of the 16th largest bank in the US, Silicon Valley Bank. I want to talk about what happened, why it happened, what happens to depositors and their deposits now, and what is the potential for this to happen at other banks, more specifically Charles Schwab, where most of my clients' assets are custodied. Before I get into all that, I do want to make clear two things. One, this is not like 2008. This is a very different situation. And two, based on the actions yesterday, it seems that all depositors' deposits are going to be backstopped and available even in the event of other bank failures. Inherently, the problem is there's a asset liability mismatch. So a bank takes in deposits and it owes those to its clients, right? That's a liability. But it takes those deposits and it invests them in other things, or it makes loans. That's how it makes money. It makes money on its investments in loans. It can pay some interest out on the checking and savings accounts. It can fund the operations of the bank. So inherently, the deposits that are in your checking account are not all available there for all the bank's clients. If you deposit $100, maybe 10% of that is kept on hand and the other 90 is invested or loaned out. So if a large portion of bank clients are requesting their money, there's simply not enough there in a short period of time. Now, the assets are there. The problem in this case, and it's very different than 2008, is that in 2008, the banks owned a lot of very low quality credit securities, basically mortgages and derivatives that included mortgages and were built on top of mortgages. And the mortgages were no income, no documentation, adjustable rate mortgages. So as those started to default in an economic downturn, the whole house of cards came collapsing. And a lot of banks had a lot of those assets on the balance sheet, but they were worth far less than they were stated or completely worthless. And so that caused the issue then. Today, that's not the same issue. The assets that even Silicon Valley Bank owned were largely very safe, government-backed bonds and agency securities and mortgages. However, they were long-term securities. So as interest rates have been rising for the last year, the value of those securities have fallen. So once they had to start selling a bunch of these assets to satisfy the withdrawal request, all of a sudden they were incurring a bunch of losses on these securities. This is why I always preach the asset must match the liability. And when I talk about it, I'm talking about it in terms of a household, but it applies to non-financial businesses and financial businesses as well. And the idea there is that if you have a known liability, the asset you're going to use to fund that liability must match. So if I'm buying a house in a year and I need a 20% down payment and I have that money right now and I'm looking to do something with that, I'm not going to invest that, let's say $100,000, in the stock market because stocks are at this point, a 20-year asset. I'm not even going to buy a 5-year bond, safe bond with that 100,000 because 5 years and I need the cash in 1 year, the value of that bond could be lower than when I need to redeem it in a year's time. So the asset must match. So maybe I buy a 1-year bond or a CD or just leave it in cash. That's what I mean by the asset must match the liability. For households who are retiring, it's the same concept. We're retiring and we know we need to fund our expenses every month from a portfolio. We know we have a cash need. So we need to incorporate assets in the portfolio that satisfies that cash need. We can't invest all in stocks knowing that we're pulling money out every single month because stocks could very well be down and we'd have to sell these assets at lower prices to fund the cash need. We'd much rather have short-term assets that mature as we need the cash. And that's why I structure portfolios the way I do for retiring clients. Some say I'm too conservative, but now you understand why I do that, right? It's so we can tolerate volatility on the longer term assets and fund our cash needs without worrying about what the value of that asset is going to be. Well, Silicon Valley Bank had a bunch of short-term liabilities in the form of deposits that they own their clients, but the assets they used to fund them were all very long-term. So these assets have all lost a lot of money over the last year as interest rates have risen. And so as they needed to sell them, once again, they incurred the losses and they were insolvent. So the question is, what happens now to depositors and their deposits? Well, at the end of last week, we knew that the insured deposits, so the FDIC insurance of $250,000 per account, we knew the insured deposits would be available Monday morning. What we didn't know is what was going to happen to the uninsured portion of the deposit, so those exceeding $250,000 insurance limit from the FDIC. The idea there was that these people might get a dividend and a receivership certificate, and so they would gradually maybe get money over time, but we didn't know how long that would be. Well, yesterday, to instill confidence in the system and to portray that these deposits will be good no matter what and accessible to you, the Fed is going to backstop these deposits so that even 100% of the uninsured balances will be accessible. So now the question of, will this happen at other banks, and particularly Schwab? So it's certainly possible. This can happen at any bank. Even the best managed banks are subject to a bank run just by nature of the way the banking system works, which is long-term assets to try to support short-term liabilities. So anytime there's a crisis in confidence and people start withdrawing their money at a fairly high rate, almost any bank's going to be insolvent. However, the steps the various authorities took over the weekend have probably greatly reduced the probability of many more bank runs like we just saw last week. And again, that facility is the lending facility where these banks can use good, sound, high quality collateral or bonds as collateral for loans from the Fed. They can use the proceeds from those loans, satisfy any capital needs without having to sell those bonds at the reduced prices. So that was the big thing with Silicon Valley Bank, is that they were forced to sell these assets and take big losses, thereby eroding their capital position. So that step alone has probably gone a long way into avoiding what could have been a really bad week with widespread bank runs at various institutions. Silicon Valley Bank also had some other nuances associated with it that made it more susceptible to what they just went through. One is they had a very concentrated client base all within the tech sector. So if that sector experiences pain or a slowdown, there's going to be a greater cash burn and a greater demand on the deposits. That's number one. Number two is Silicon Valley Bank had over 95% of its deposits were uninsured by the FDIC because they exceeded a $250,000 insurance limit. Compare that to someone like Schwab, where only 20% of its deposits are uninsured because they exceed that $250,000 limit. The reason why that's a problem is the more assets you have that are not insured, the more finicky and skittish your client base is going to be. So if there's any scent of a problem and there's $100 million of uninsured money there, you're going to have a race to try to get that money out so you're not left holding the bag. Schwab has better capital or better leverage ratios. I believe the regulatory minimum is 4%. Schwab is over 7%. So from that standpoint, they're in a better position. Schwab has various diverse funding sources, especially with this new facility created over the weekend, where they can use their long-term, high-quality bonds as collateral for short-term funding without having to sell those assets. They have access to, I think, $80 billion from the FHLB, plus they have their cash and securities on hand. So generally speaking, the risk has now probably been reduced over the weekend for various institutions to fail this week. It looks like there's still concerns about some institutions out there, but even if there are failures, steps have been taken to make sure depositors are not losing money. Now, let's just go through the worst case scenario real quickly. If Schwab were to fail, for example, the bank, a subsidiary of Charles Schwab, which is a much more diverse business than just the bank, the brokerage accounts are protected by SIPC, so that's $500,000 of insurance coverage per account. And you could have multiple accounts at the same institution that all have their own $500,000 insurance coverage. So, for example, a household could have an account in the husband name, an account in the wife's name, and a joint account. Those three accounts would each have $500,000 of coverage, so $1.5 million of coverage. You throw some IRAs and Roth IRAs in there, and you could easily see, several $1 million of insurance coverage on a household's accounts, even if they're all at the same institution. Now, you can't take two joint accounts and just create duplicate accounts. You can't create a joint account where the names are reversed on the account. Those are all treated as one, but there are ways to increase your coverage. Additionally, obviously you can open, if you're exceeding the $500,000 insurance coverage limits, you can open other accounts at other institutions. So, if you had $4 million in an account at Schwab, you can open various accounts, spread that out. You can open at other institutions and spread that out further. So there's ways to protect yourself. But even in the event of a brokerage failure, it's important to note that broker-dealers are required to segregate client assets. So they're not subject to the general creditors of the firm, and they are protected. Broker-dealers are very highly regulated. There are strict reporting and auditing requirements to ensure compliance. So at a firm like Schwab, there's not likely theft and fraud. Of course, it's possible anywhere, but it's very unlikely, and those client assets are segregated from the assets of Schwab, the firm. So in that event of a brokerage failure, typically the way that gets resolved is the brokerage accounts simply get transferred to a different brokerage firm. And then there's coverage there, again, by SIPC if there's any assets missing due to theft or fraud. The track record of FDIC and SIPC is fantastic as far as recovery. So in all, I suppose it would be certainly a headache, and it could be a scary period of time if a brokerage firm were to fail. But it seems the regulations and the processes are in place to handle that smoothly and recover the funds.